Meet Kyle. He turned $26 into 2.7 million, and he did it using 4 easy rules.
The last bull cycle, I was able to flip 15 grand into $300,000. Then I went from 300,000 to 2.7 million. The last trade changed my life. It allowed me to get a house, allowed me to get this crazy cool studio. Yeah, it changed my life. My story can be anybody's story because, dude, I'm not really that special. It's just, if I can figure it out, literally anyone can figure it out. I just hated my job enough to start this. That's all that really took.
But what's amazing is he's helped others do the same.
There's one member that's basically start with $250 and in 8 months turn that $250 into $1 million.
He posted his entire multi-million-dollar trade step by step on FINOVA so members could copy his results in real time. Here's why I interviewed Kyle. I wanted him to take me through his insane story from the beginning, where he left this job that he hated, he had to get out of debt, he then got scammed, leaving him with $27 to his name, and then he took that tiny little $27 pocket change and turned it into generational wealth.
I was working at a call center when I quit my job. Debt interest in combination to my bills was actually outpacing what I made per month. So I needed to find a solution that was scalable, and I found that through trading. And I was able to grow my account from $26 to over 2.7 million.
You know what? I'm going to take you through my entire interview with Kyle where he explains the 4 simple trading rules that made him $2.7 million and how he protects that money, the 2 free tools that he uses every single day, the warning signs that he follows to buy and sell, how he would start again with as little as $100, and I asked him what 4 coins he's watching right now outside of Bitcoin, so stick around for those. Now, this isn't financial advice. It's just the strategy used by an everyday guy who has a crazy success story. It's up to you whether you want to take on the risk and try this yourself. It's just a story that I felt the world needed to hear. The key principles. As you'll see in a second, Kyle's strategy is extremely simple, but to pull it off, you need to lock down some key principles that will keep you safe. And the first one is so crucial. It's allowed him to time his trades almost perfectly, like suspiciously well.
The problem with a lot of traders and investors is they're impatient. They want to get rich quick. If you are trying to force an opportunity that isn't there, you usually end up being the liquidity that makes other people money. Be as patient as you can and wait for the rules to tell you when to get out.
But of course, patience by itself, that's not enough. Kyle also needed some fixed guidelines for how to approach risk. That way he can prevent himself from making huge mistakes.
There's some things that everyone needs to be aware of. They also need to know how to manage their risk. No, don't use too much leverage. Use a safe amount of funds. Always risk to lose 1% to gain 2. Always have your stop loss set up. It's the only thing protecting your wealth, and it can allow you to grow. When it comes to limit orders, getting it set up so it automatically exits the trade for you at a profit. What I'll do instead, I'll either set an alarm if it's during the day, when it's time to go to sleep, I'll set a limit order, and then that way I'm making income while I'm asleep. I think of the stop loss as a budget. Everyone has to drive to get to work and pay for gas. And when I lose a trade, I'm just paying for gas. So I just paid for gas. And the next trade, because of my risk to reward ratio, is always going to be worth more than the loss that just occurred. So it allowed me to scale.
And if you like Kyle's style so far, you're absolutely in luck because you can actually follow his every move in real time. That's because Kyle is a full-time trader over on the FINOVA Patreon. This is a service where I give access to all of my personal investments in my entire portfolio. I offer 50+ hours of training material, and as you can see, I seek out the best traders in the world, like Kyle, to make this the most profitable trading service in the world. Here are some of his recent trades. That'll be linked below. So as Kyle traded, he learned how to better allocate his time, and what he discovered surprised him, as it ran opposite to what most new traders were actually doing.
A new person just getting into the market, learning how to trade, they're probably looking at the chart and probably over trading, doing 10, 20 trades when they really only need to do 1 or 2 to make the same amount of money. I can look at a chart in 15 minutes and I'll know what I'm doing for the rest of the day. When I first started, I was doing it 10 hours a day. When you just got a rule book and you just got to follow the rule book and you just got to wait for those rules to be met, you can literally set alarms on your chart to tell you when to start looking at the screen. So you only need to dedicate like 45 minutes a day.
But principles aren't enough. He also had rules based on solid data. Here are the 4 simple rules that made him $2.7 million. His rules start with a tool called chainexposed.com. It's a free tool that collects on-chain and technical analysis metrics to help people predict the market. But Kyle only focuses on a few super specific graphs.
This is like one of my favorite charts. It's supply and profit and loss. So you can see when I move my cruiser here, you can see that it's showing you based on the current price where this black line is, what the supply is in percentage of profit, like how much of the supply is in profit and how much of it is in loss. 67% of people were in a profit and 32% were in a loss. Obviously, as the price goes down, the more people are in a loss and less people are in a profit. You can help use this as a tool to tell you like when's the best time to buy and when's the best time to get out. And as we get closer and closer to all-time highs, it's inevitable that like 100% of the supply is going to be in a profit. What I look for in this, it tells me like basically how exhausted are we in the market, and it helps me call the tops a lot better, and it helps me call the bottoms. I usually want to see before I decide to buy for a macro trade, I want to see like at least around 50% of holders at a loss. That helps me identify like, okay, we're in a state of capitulation. There's a lot of fear in the market, and everyone's heard like, buy into fear, sell into greed. It's basically this. This shows you exactly what's going on in the background for that.
So that's rule number one. Prepare to buy when supply and profit or loss has 50% at loss. He uses that graph to give him cold hard data. I shouldn't make that hand movement. To give him cold hard data on how much fear is in the market. When that sinks below 50%, that's a good sign, but it's not the only sign.
And then when we go to the relative unrealized profit chart, this one here, there's what's called the opportunity zone down here, this green box. And when we're in this is another rule. I want to see price inside this green box. This is when we're in a state of capitulation. Not just holders, but also miners are at a loss. There's a lot of people that are at a loss right here. When I see we're in the green box, it's time to buy. Pretty simple. Just wait for this little line to get in here. That's one of the rules that needs to be met for a buy. And it's just as simple for when it's time to sell. When we see price action above 2.35, when we're in this overheated zone, this is one of the rules to prepare to sell. It's very explanatory. There's colors. Anyone can look at this chart and figure out what it means, right? But basically what's happening in the background, this is like unrealized profits going on here. And when we're below zero, there aren't any unrealized profits. So there's like a lot of unrealized losses. This cycle is going to be a little bit different. I'm anticipating like a 50% correction rather than like an 80 or 90 because of the ETFs. They legally have to hold it to sell it to their clients, and that will create a new base floor for Bitcoin. Prepare to sell it overheated, prepare to buy at the opportunity zone. And that's another easy rule to follow.
And that's rule number two. Prepare to buy when the relative unrealized profit is below zero in the green opportunity zone. The logic is that when the price is in the green box, it means that a ton of people are at a loss and it's time to buy. But all of his rules aren't met quite yet. We also need to look at the Nupal chart.
Then we have the Nupal chart. Same kind of analytics. When we're below the zero line, you'll see that there's a bunch of little lines here. The black one represents the price. The red one here represents long-term holders and what they are doing. And then this orange one is basically everybody in the mix, not just it's long-term and short-term mixed into that. When you see both long-term and short-term down here at a loss, it's time to prepare to buy. When you see people at a state of capitulation, people are at a loss, it's the best time to prepare to buy historically for Bitcoin. These charts have called the bottom almost perfectly every single time. Even like the little COVID crash that we had, it's telling you it's time to buy. So that's pretty much it for the on-chain stuff, man. It's very simple.
That's rule number three. Prepare to buy when long-term holders and average holders are in a state of capitulation, meaning down below the zero line on that chart. Again, he's looking for real-world signs on-chain that show the market is full of fear. That's when he's targeting a buy. The first three rules here on Chain Exposed are extremely important.
You want to see this line, basically price the Nupal chart showing that the long-term holders and the average holders at a state of capitulation, there were a loss, we're down below the zero line. We prepare to buy when we start seeing about 50% of the supply at a loss, and we prepare to buy when we see this in the opportunity zone below zero.
So this gives you a good idea of market activity and sentiment, but we still got rule number 4, which requires a completely different chart on TradingView, another free tool.
And then it's about the chart. What's the price doing? So we go into the chart, it's about the structure. So if we zoom out on Bitcoin, we have what's called a legacy trend line right here. And this is a trend line that's been holding up Bitcoin since 2017. When we reach this level, you can either use this line or you can use the 300 weekly EMA. I find this line just to be a lot more accurate. It's called legacy support. When you draw a trend line and you're going on the daily chart and you're trying to get as many connection points as you can for support, it'll give you a good idea of where the bottom's going to be. And it tells you, and you can see that's trending upward, right? So like the floor value of Bitcoin is going up based on this trend line. As time goes by, it's going to get higher and higher and higher, and it's going to help define where Bitcoin's likely going to go when we have the next bear market correction. You look at this as your target to rebuy. And when it comes to selling, it's a little bit different. Like calling the tops a little bit more difficult, but it's the same on-chain rules, but in reverse. And then you just want to wait for a loss of uptrending support. This is a trade when you jump into it, you go in with the mindset that it could last over a year.
Rule number 4, prepare to buy when the price hits the legacy support trend line. The logic here is that once you've determined the market is in a state of capitulation, you can then look at the Bitcoin price to see where the bottom will be. When it hits its legacy support, that's where you buy, and that's where you potentially make this insane return. This way, you're looking to start a trade at a good evidence-backed level of market fear and a reasonably low price. In essence, he's kind of using data to invest exactly like that famous quote you've probably heard before: be greedy when others are fearful, and fearful when others are greedy. As I said in the start, Kyle took FINOVA members through this trade as it happened in real time. This is one of the most profitable trade signals of all time, and it was available right on FINOVA, meaning you would have had access to this trade and so many more if you were a member at the time. If you don't want to miss out on the next trade from Kyle, myself, or any other FINOVA trader, make sure to join. But just a warning, join fast because we sell out of spots every single week. Now, Kyle's strategy works for any kind of trading, but typically he uses it for an inverse perpetual trade that has a unique fee structure. This is where you leverage Bitcoin to predict futures. I'll let him explain.
So an inverse perpetual trade is a lot like trading with regular futures where you're predicting the direction. You can go short, you can go long. So like short predicting it to go down, long predicting for it to go up. Rather than using USDT or USDC like most people do, you use Bitcoin. So you're putting your Bitcoin into the trade. It's called coin margin, or it's called inverse perpetual, depending on the exchange. Most people know it now today as coin margin. But when you enter that trade, you choose your leverage just like you do with any other setup. And you basically, that will determine your volume. So my 10 Bitcoin acted like 20 Bitcoin in this trade. Most of the major big exchange has coin margin or inverse perpetual.
Just a word of warning, you need to be careful with trades like these because the fees can scale rapidly. That's actually what got him out of this trade in the first place. So you need to have money set aside to cover those fees, otherwise your trade will be closed early. But let's say you hit a big win. What's next? Well, as you can guess, Kyle has key rules for selling as well.
And you'll notice that the short-term holders on chain will start to go up and the long-term holders start to go down. And we just had that occurrence go through now. So we've got the warning sign that we're halfway through the bull market. Now we just got to wait until we are seeing about 80% of short-term holders in a profit again. And that's a warning sign. And then this gets to the overheated zone. That's the next warning sign. Then we lose support on the chart. Here.
So in essence, you sell when it's the reverse of all the buy rules that we've already talked about. But returning to buying, Kyle's rules aren't quite enough. He relies on a couple signs that have to be in place before he even checks his 4 rules to begin the trade. So how to know when to buy. To do this, he looks at a piece of data called the golden accumulation chart.
I call it the golden accumulation chart. This is called the 200 weekly EMA. It's basically think of it like every single time there's a weekly candle that's printed, it creates an average and it generates this line. So this is like a combination of 200 weeks of candles that tell you where the current average is. And it creates a really big weighted level of support. And when it breaks, it's actually known to be one of the best times to buy. So if you use the break of the 200 weekly EMA, this green line here, in combination with the on-chain data, you can get yourself a really good entry price. Of course, you can use formations to help guide you too, like devil bottoms are huge warning signs to prepare to buy. Like this is the bottom. You're not going to have another opportunity to buy. So you can see them here. They're like big W's.
By looking at the 200 weekly EMA and double bottoms, Kyle was able to see whether he should start looking into a trade. When he sees the right information, he then checks his 4 key rules.
So you use this chart. Whenever you see this box pop up, you prepare to buy, and then you just go through the rules that we went through on chain. And once all those rules are met, it tends to get you the best entry. A lot of people jump the gun and they'll get really hypey when they see price action get down below here, but it's not enough. Just wait till all the rules are met and it'll save you tons of money and time.
Be patient, look for the yellow box. This means it might be time to buy, but then check your 4 rules first. If they're all met, buy. If they haven't, wait. It's that simple. Don't try and create an opportunity. Wait for one to arrive. That was the backbone of how Kyle made his $2.6 million from 27 bucks. But remember, without patience and without emotional management, it's just not going to happen.
They're impatient. They want to get rich quick. If you are trying to force an opportunity that isn't there, you usually end up being the liquidity that makes other people money. Be as patient as you can and wait for the rules to tell you when to get out. Honestly, that's the biggest thing. Emotions will destroy you.
He also told me something surprising, that most people could become a millionaire in far fewer trades than they think. How many trades for the average person?
The average person can become a millionaire in 300 trades. It also, of course, depends on what you start with. But if you're starting with like $1,000, the average person can become a millionaire in like 300 trades. That's including losses in that too.
So 300 trades total, like realistically not that many. But if you're using his rulebook and his strategy, how long does that take per day?
if you got your rule book in your pocket and you just wait for it to meet those rules. You're looking at like 45 minutes to an hour per day.
An hour a day. I asked him something that I think would apply to a lot of viewers, something achievable. How would he start again with as little as $100?
If I were to go back in time and start completely all over again, like I know I wasn't very fortunate at the time, so $100 would probably be a lot to me. The reason why I would recommend most people to start with a small amount is because as your account grows, you're actually training your emotions little by little to handle a larger and larger account balance. Emotions is a huge factor when it comes to trading. A lot of people jump into a trade that they do not belong in. If I were to give you a set of rules and you cannot enter a trade unless those rules are met, it's not going to matter if your emotions get in the way and try to jump you into a trade that you're not supposed to be in. I would still start small so I can still train my emotions, give myself a set of rules, and not chase after the new shiny indicator. That was a big problem with me when I first started trading, is I would try to add more rules, look at other indicators, add more rules, stuff like that, and not analyzing how it's going to impact my win rate. So backtest every single thing that you hear when it comes to trading, and especially in the crypto space. You want to make sure that those rules, if you were to apply them, if you were to backtest it, you would give yourself a percentage value of how often you're going to win a trade. So if you give yourself like a sample size of 100 or 200 trades and you find out what your win rate is going to be using those rules, then you would have yourself some data that would literally tell you exactly where you're going to be from now after 300 or 400 trades. And you can actually predict where you're going to be at mathematically in terms of profitability. Risk management is incredibly important. You know, if you're trading with $100, you should be risking around $1 to gain $2. You know, you should always be risking to gain more than what you're willing to lose, and let yourself scale through compounding that way. As your account grows, you know, maybe it gets to $200, you'll be risking to lose $2 to gain $4. And when you're at $300, you'll be risking $3 to gain $6, and so on and so forth. And you'll find yourself one day trading with 15 grand and be able to quit your job or stuff like that. And another tip I would give myself as well is if I were to try to think about quitting my job again, I would highly recommend having at least a 6-month emergency fund. When your trades are the only thing that's paying for your bills, it could add a lot more stress into trading, and you want to be as calm as you possibly can as a trader. So having a good lush fund to fall back on is more than recommended.
And we aren't done yet. I know you love hearing about coins outside of Bitcoin. So I asked him what else he was looking at and what interests him about the market right now. The 4 coins Kyle is watching.
When it comes to other coins other than Bitcoin, I like to look at all these cryptocurrencies, all these different assets as their own vehicle. What I mean by that is I want to see which one's going to hit their destination the fastest and which one has the most amount of safety features. Rather than an airbag, basically what I mean is which vehicle has the most amount of holders, the most amount of liquidity, the best development plan, the best marketing, stuff like that. And I want to jump in on the vehicle that will basically get to the destination as quickly as possible. So I can take those funds out and put them into a different vehicle that hasn't even started going yet and compound and grow that way. So when it comes to larger market cap, I'm focusing mostly on like Solana, Chainlink, and Ethereum. When it comes to lower market cap assets, you got to take a huge step backwards and think about what is the narrative that everyone's talking about right now? What is everyone talking about right now? It doesn't have to be in the crypto space, just in general. And right now it seems to be artificial intelligence. Like AI is the big hype that's going on right now around the world. When you are looking at the AI sector in the crypto space, you can see that they're outperforming even Bitcoin right now. So short term, you basically want to get in and out as quickly as you possibly can, and you just want to think about which assets are the loudest right now and which one's got the, just like I said before with the higher market cap stuff, like which one has the best roadmap and the best marketing plan and the best which technology you think is going to be a disruptor in the space. Yeah, for this cycle, I would say artificial intelligence for the lower market cap stuff, and you invest in a significantly a lot less funds than you do with the larger market cap stuff, like scratch ticket amount of funds, basically.
As you can imagine, I've been following this trade for years, and to see him go and take this bold signal a while ago with $300,000, being patient through all the ups and downs, and then eventually selling right on the dot and making $2.7 million. I have never been more proud to see a trade and to see this level of resilience and emotional regulation. It's insane. It really is insanely impressive. I'm so excited to have him on the FINOVA team. If you want to learn even more, you can join us over on the FINOVA Patreon. Love you. Bye.